Hello and welcome to another episode of Be the Bank, the very best place on the internet to learn about the secondary mortgage market. My name's Robert Heitha, and it's my job to teach you what I know about this industry so you can have success in this space as well. So I want to get started with the show, but before we begin, I want to thank now 58 Mastermind members. We've got a really great group growing, and we'll tell you a lot more about that later in the show. But just wanted to throw a shout out to the 58 members, the note investors who have joined our mastermind group to make it what it is today. So thank you to all of you. All right, let's get into the show and start it up. All right, it's episode number 31 on the March 31st, the end of March episode. We do this show the last Wednesday of the month, every single month. And we're gonna start with the show at the top with some free resources for note investors. Then we're gonna talk overview of the industry. Then we're getting into a very exciting portion of this episode, and that's the tech. This is a phone and a laptop business. And if you have some other hardware, for example, like this, the Stream Deck, this piece of hardware right here, we can do some really amazing automation, and I'm still getting to figure it out here, so bear with me. However, I have built two automations for due diligence for note investors that I want to share with you in the tech section of this episode. Then we're talking how to acquire assets through the sellers that I work with, then some case studies, of course, and then finally giveaways, show you how you get on a call with me for a consultation for free. All right, so let's jump into it with some free resources for note investors. You already know this stuff if you've seen the show, so I'm gonna go through it quickly. FIXnotes.com/learn is our free online course, how to invest in mortgage notes. Would highly recommend you check that out if you're just getting started or if you wanna brush up on your skills as a note investor. Totally free, 100%. You do have to put in your email address after a couple modules, but it's certainly worthwhile to check out. Then we've got the news, FIXnotes.com/news. It's an RSS feed, an aggregator across the industry of all the relevant information that I'm finding out in the marketplace that you need to understand to stay on top of the goings on in this space. We've got FIXnotes.com/terms, a whole glossary. It's another language sometimes with all of the things you need to learn in this business. So we've got a great resource for you there. All right, now that we've gotten through that housekeeping, let's get into the industry overview. And I want to just recap what we talked about last week, and that is the mortgage note investment options. So there's many different ways you can get started in this space, from passive to active opportunities. Now, passive opportunities are lower returns. Active opportunities obviously are higher returns. You have to put in more work. Starts on the passive side with investing in a mortgage note fund. We have a company that is managing a portfolio of notes and seeking investors to secure their investment across an entire portfolio of notes. The returns are lower, the risk is lower as well, so you're diversified right off the bat with a small investment in a mortgage note fund. An equity partnership is slightly more active and it's better returns if you work with a private investor and you're funding a portfolio that investor is managing for you. It could be a silent partner, or you could work into more of a active role with an equity partnership like this. Next, we have partial acquisition of cash flowing loans, which are buying reperforming loans to collect cash flow and ideally not have a whole bunch of work on the portfolio management side if the loans are already performing. Next, we have buying cash flowing whole loans. So partial acquisitions are just buying a piece of a cash flow. So you could buy an investor's performing note and basically only buy a portion of those payments. For example, an investor might be owed 120 payments. They could sell the front end, the first 60 payments of that cash flow, to an investor and then retain the remaining 60 payments. That's a little more passive than buying whole cash flowing loans because you have another investor who has a vested interest, and they're ideally going to be helping keep that loan performing. When you buy cash flowing loans yourself, reperforming whole loans, you need to do more portfolio management because you are the sole owner of those cash flowing assets. And then finally, the focus of this show is buying and working out non-performing loans. I think it's important if you're going into any of these other more passive investment opportunities in the note industry that you understand how it works at the high level, buying and working out non-performing loans, because those are the highest returns and what most mortgage note funds are going to be operating anyway. So to understand this is going to give you a lot more information when making decisions about funds to invest in or specific assets to buy. So couple things we want to talk about when we're talking about non-performing loans. And the first is pricing, and then we'll get into due diligence. So pricing has seen some changes in the last month. I've actually seen the highest pricing that I've ever seen in non-performing second mortgages over these last few weeks. Now, we listed some assets for sale in February, and we just finalized those portfolio sales at the end of March. In this past week, we just wrapped up about $900,000 of sales. And I've seen pricing on non-performing second loans approaching 80% of the unpaid principal balance. These are not performing, but they do have equity and they're behind current senior liens. So that's this box here, non-performing junior liens, priced based on unpaid principal balance and approaching 75% of unpaid principal balance, although we did see one asset sell for over 80% of the unpaid principal balance. So that was somewhat of an outlier, and I believe that in general, these increasing pricing on the non-performing side is more a result of generally rising tides across every asset class. Not necessarily just in mortgage notes, but the underlying collateral, the real estate, as well as equity prices and commodity prices. Pricing seems to be going up. There's a very fierce debate right now about inflation and whether or not we're going to see inflation in the coming months to years, but I think you might be able to see that we already are seeing it in asset prices across the board. So just to give you a high level here, and we've talked about this chart many times, so I'll keep it quick, but reperforming loans are priced based on yield. Non-performing loans are priced as a percentage of fair market value or unpaid principal balance. The reason we price reperforming loans based on yield is similar to cap rates in traditional real estate deals. You're looking at the cash flow. And as an investor buying a cash flowing asset, you want to make sure that your money is being put to work at a rate that compensates you for the risk. So that's why we price reperforming loans based on yield. Non-performing loans in senior position are priced based on fair market value. That's because senior liens more often resolve through the collateral and not through the borrower. And when we resolve a deal through the collateral, the underlying property that secures that debt, we're typically seeing a pricing based on that value of the underlying collateral. You're not going to be paying more than the property's worth to buy the debt secured by that property. And oftentimes senior liens are underwater, meaning that there's negative equity in those deals. So you're not going to be paying a percentage of the balance that's greater than the fair market value of your underlying collateral. On junior liens, the non-performing loans are priced based on unpaid principal balance because contrary to first liens that resolve through the collateral more often through the property, junior liens resolve more often through the borrower, getting a workout done, either a modification agreement or a payoff with the borrower. So we price these loans based on the unpaid principal balance. And that can see a range of anywhere from 5% up to 70 and even 80% of the unpaid principal balance. So there are many factors that go into pricing a non-performing mortgage note. So we're going to look at evaluating non-performing loans through the waterfall due diligence process. So I'll actually switch to this one here so you can see a little bit better what we're talking about. And I guess I'm just going to cover up those for now since we're talking at the top. So secured versus unsecured is the first thing that we look at when we're pricing out a non-performing loan. If you've seen the show, you know that. It's the most important because if you do not have a secured lien, you do not have any collateral to enforce your lien against. You cannot foreclose on an unsecured loan because there is no collateral underlying that debt. Once we know it's secured, then we look at first versus seconds. Now, we talked about these first two sections, secured versus unsecured and first versus second, in our last episode, and that was starting with the secured status, understanding that when the property owner equals the borrower on the data tape, the loan is secured. A lien becomes unsecured through a foreclosure from the senior lien position or a foreclosure through a tax deed sale or another type of sheriff sale through another senior lien. And a personal liability remains after a foreclosure. So personal liability is the ability for a lender to pursue the note. And the note, a promissory note, is a promise of that borrower to pay back the loan. The promissory note is connected through the mortgage to secure that debt against real property. But when a loan is unsecured, it does still retain that personal liability. But there are some ways you can lose that personal liability, two of which are the statute of limitations or a discharge bankruptcy. So if you want to go back to 2 episodes ago, episode 29, you can learn a little bit more about how we determine property ownership and understand those false positives versus negatives. In Last month's episode, we talked about juniors versus senior liens, and in my opinion, why the smart money prefers second position loans. So another slide that you can really get into more detail in last month's episode, but just to show it on the screen here so you can absorb this information if you're just tuning in for the first time, leave it up for a second. And now moving on to collateral value. So collateral value is this next box, and this is very important for secured liens, of course, because it's the underlying security instrument. It's what is protecting your debt, the value of the property, the value of the single family residential property, in most cases in this industry that I deal with. So we're gonna be talking about collateral valuation methods. This is a new slide for a new episode, and we're gonna talk about how to go from free sources that are sometimes less accurate to paid sources which are advertised as being more accurate, but you'll find there's a sweet spot right in the middle that I believe is the best way to value collateral when you don't want to pay for a broker price opinion. So in the free side, we start with AVMs, automated valuation models. Now, Zillow, Trulia, ePraisalHomes.com, Homes.com, Chase Home Value Estimator, there's a whole bunch of these. Redfin has their own AVMs. You could even just Google property AVMs and find a whole bunch of free resources to value properties algorithmically, essentially. They're just using the data that they have on recent sales to then come up with an estimated price on any particular property. And all of these are free, so you can search an address and get a value. Now, I'd recommend triangulating these values in most cases, essentially creating a spreadsheet with all of the different potential values from all the different potential sources, and then either averaging them or taking a quartile, maybe the second quartile, which would be a little less than the average. Or if you wanted to price it more aggressively, you could go to the third quartile. That's an Excel formula that you can Google, a quartile formula, to learn more about that. But essentially, these AVMs give you data points as to what the property is potentially worth. If you want to spend a little bit of money on an AVM, there are some AVMs that you can actually pay for, including the Atom AVM, the CoreLogic Geo AVM, House Canary, and of course you can Google this as well and find a whole bunch of different possible options for paid AVMs. I probably would not recommend these paid AVMs. I do use the CoreLogic Geo AVM, but it's more a function of researching credit data and then just having that AVM populated on the spreadsheet by CoreLogic with the output file. I wouldn't pay for this on its own, but it has its place in many investors' due diligence process. Here's the sweet spot though. Doing a manual review yourself of recently sold comps. Now this is free, but it costs you your time. So it's right in the middle of this chart here because you are going to be spending more time doing this type of research than you would doing this type of research. These AVMs can often be calculated and run via an API or through like something like Zapier to run a web scraper essentially to collect these data points automatically. But looking at recently sold comps and doing a manual review, that does depend on your efforts. So it takes a little bit longer here. We'll get into that in a little bit more detail in a moment. Let's talk about two more. One is a desktop appraisal by a professional. So a desktop appraisal is pretty much the same thing as doing a manual review of recently sold comps, but you'd be paying someone to do that who is a licensed real estate professional. And if you want to go all the way to the top, which is, it is the most accurate, a broker's price opinion, because a broker actually needs to do a drive-by of the property and see boots on the ground what that home looks like. So a BPO is going to be your most accurate way to value a property, but it will be the most expensive, often costing about $100 to run a broker's price opinion. Now it comes with a much better set of data. You're going to be getting photos of the property and a whole report on why the property is worth what the broker thinks it's worth. So it is worth paying for, especially in first position loans. As we've discussed, first liens are more important to review the collateral because we are pricing based on the fair market value of the collateral. So BPOs are most often used analyzing first position loans. So before we dig into recently sold comps and how you can run your own desktop appraisal, I'm gonna just take a look around at some of the birds that we see because this is a bird watching show as well as a mortgage note investing show. So we've got a little, is that like a house sparrow, I think? hanging out with the shelled nuts. We've got some really great bird food out there. And look at that. That's a female cardinal on the other side. So that's it for now. Some birds to look at while we contemplate the desktop appraisal. Now, a desktop appraisal is something really cool because the internet allows you to do this from anywhere in the world. So I'm gonna change over, hopefully this will fit everything. All right, so option one is going to Zillow.com/seller-landing/pricing tool. Now you can just Google Zillow recent comps or just Zillow comparable properties and find this page linked on Google as well. This is a really, really cool tool though, because it essentially automates some of this process for you. So let me make the screen bigger here and show you what this looks like. So essentially I Googled I Zillow searched an address 123 Main Street, and it gave me a couple comparable homes, and then they're telling me based on these comps how similar this property is to these different properties. Now this is just a screenshot, but if you scroll down, there's a whole bunch of other properties on this list, and you can click this add to my estimate button to essentially generate a report about recently sold comps. So very cool when it works. However, not every property gets populated. If they don't have enough data, you won't have this as an option. So the next option is to find the subject property and then scroll down to similar recently sold homes. Now, way more properties on Zillow have this as an option, and you've probably already seen this. It's this button over here, similar recently sold homes. And that essentially just scrolls you down to this section where you'll see the same thing you saw on the last page on Zillow, but way more homes will have this data available. So then you can click in and you can see what homes have sold and how close they are. You can get a lot more detail maybe about the interior condition if you click through and look at the photos. But this is a very good way to see what properties are selling for in the marketplace. Now this chart right above it is the homes that are comparable and are actively for sale. Also, very important to understand as you are valuing a home and not just relying on the Zestimate. To do an actual research on what you think that home might sell for based on the homes that have sold and the homes on the marketplace. So let's look at another option here. Find the subject on the map and then select sold homes. So the yellow button up here is for sold homes. I would select both sold and for sale, and then look at that map and look for all of these little dots. So you can see not only what the values are, but also how close. Is one a corner lot or maybe a larger parcel? Is it across from the park? There's all these different intangibles that you can see when you're looking at a map that you might not have gathered by just looking at these thumbnails of the different properties. So very important, and I would recommend doing all three, especially these second two if the first one doesn't work, because this often doesn't. All right, some tips here. So first of all, consider the location, the square footage of the lot and of the actual home, the beds and baths, the sold date. Maybe it was a recently sold comp, maybe it was a similar comparable property, but it wasn't recently sold. So you got to check those dates. Also check the construction date to see if it's actually a like home. If it's been recently constructed and the home you're looking at is maybe a historic property, there's a whole different set of equations that you want to look at there to make sure that you've got a home that's in good condition. Although sometimes those older homes are worth more, so it's important to really dig into those intangibles to understand above and beyond just the numbers on the screen, really understanding what that marketplace is like. Now, Google Street View is the most important thing to do on top of all of this, because similar to that broker's price opinion where you actually have a realtor going out and telling you what that home looks like, the boots on the ground, Google Street View will let you see hopefully a recent photo of that property to determine whether or not the lawn is cut, whether or not there's a bunch of beat up cars in the front driveway, like broken down vehicles, or maybe the roof is damaged. You can see that from the satellite view. There's a whole bunch you can see from Google Street View, and I would highly recommend adding that tool to your toolbox as a note investor. And make sure you look down here, image capture date. So that's July 2011. This is not very recent, and we can't really put much stock in the fact that, you know, the landscaping looks good, the driveway's clear, the property looks really nice here, but it was, 9 years ago. What was that, 10 years ago now? It's crazy. So important thing to look at, the Google Street View is just another data point that you need to make sure that you're checking out so that you're not caught off guard when maybe the home is demolished. And I've seen properties that you'll see in the Street View, and then you'll look at the satellite image, which is often a more up-to-date image, and the satellite image shows a demolished home, a vacant lot. So very important to look at both the Street View and the satellite view. All right, so that's how to run your own desktop appraisal and triangulate that information so that you can understand what a property is worth without paying for a BPO and going a little bit beyond the typical AVM, automated valuation method. All right, so let's get into the tech tips here. So first of all, the hardware that's required in this business, a capable PC or Mac, decent smartphone, and a fast internet connection. And then the software is really where we shine in this space. We have so many different resources available to us to let us, for example, Podio, analyze and aggregate all of our data. Pacer, look at bankruptcy records, write signatures, send out automated documents to sign. Gmail, of course, is indispensable. Citrix Podio, workflow automation, and Zapier both connect to Podio to create some automations. CoreLogic lets us gather credit data and other property information across the country. DataTree does the same on a more one-off level. Both of these we've talked about in other episodes. You can search on the channel. Zillow, of course, we've done a bunch on Zillow today already. ProTitle is a really great resource, not only for secured versus unsecured lookups, but also for property taxes and ownership and encumbrance reports, a whole bunch of data there. TransUnion Credit Bureau, TLO, a skip tracing vendor that TransUnion purchased in the past couple of years. And then of course, Google Sheets and Excel, where we do so much of the really important type of data work to analyze assets for sale. So I'm really excited because we talk about hardware very rarely. I mean, we covered this slide and just kind of skim over it, but I actually have a new piece of hardware now, and that is this thing, the Stream Deck, which I want to share with you because I think that it has a new place in my workflow, and maybe will also have a place in your workflow for not only like Gmail and automations for me, at least with like changing camera angles and stuff, but also with Excel. And that's what I'm really excited to share. So the Stream Deck is essentially a big keyboard. It's got a bunch of buttons on it. And if we pull that out, you'll see the XL version. That's the one that I'm using. It has like 30 plus keys on it. But there's also one with only 6 buttons, and there's another one with like 15 buttons. So you have some options here. And you really don't need many because you have folders. Now, these two formulas are what I'm going to show you how I automated through the Stream Deck. So what we're going to do, and this is a new thing here because normally I'm sharing a different computer screen, but I'm going to share my main screen here and switch over to this page. So we've got 2 things on this page, a spreadsheet of data that we're looking at and my Stream Deck software. So let's start by showing you just around the Stream Deck. As I press buttons on, and I'll click this one, and you can see how they're shining, and you can't actually see what's happening because I need to go back off the desktop view. Oh, actually, no, I think you guys did see all of that happening. So as I click these buttons, it's changing scenes on my streaming software. And that's not really important to you because maybe you aren't live streaming, but what is cool, if I go out of this folder and click this Excel button, I'll show you, click it here. This button now has some macros that I've created, multi-actions that do some of my due diligence for me. So I want to show you before I get into these one other thing, and that is my Gmail buttons. So Gmail has some really amazing hotkeys, and what I'm doing with this setup here is creating templates for some of my common emails that I send, and then buttons to go next email and previous email, to go back to my inbox, to delete a message, to mark a message as unread. I use the pause button there since I'm going to come back to it later, or to go to forward that message to someone else, or to reply all back to that message. So Gmail hotkeys, these are all just very simple. Reply all is an A when you're in Gmail. So I just click A. Oops, that's Shift A. I click A, now I've got a hotkey for reply all. So these are super easy to set up. But what's cool is the multi-actions. That's what I'm going to show you in Excel. So hopefully we've still got, let's make sure we're still on desktop. All right, so just to switch to overhead, I think you can see me here. Hey, so this is the Stream Deck button, and if we go back to desktop, you can see the page. So pretty simple, and it's pretty low latency as well. But with Excel, this is what I want to show you. You can do some really, really cool stuff. So let me make sure, okay, cool. We're still looking at the screen. Now, when I get a data tape from a new seller, sometimes there's some data on here that's not really useful to me for analyzing purposes. And here's a good example, senior lien status. So when I open this up and see the various possibilities of senior lien status on this tape, this is a tape of non-performing junior liens, you see there's 30, 60, 30 days late, 60 days late, DEL 30, late 30. There's 4 different ways that this spreadsheet is showing me what a senior lien status is. 30 days late, DEL 30, and late 30 days are all the same thing. So if I wanted to run a pivot table on this, and a pivot table, if you don't know, is essentially a summary of this data in a different way. I would go up here, data, summarize with pivot table, new worksheet, and I want to see like senior status and the value of the property. So look at that. We've got all this data, this junk that doesn't really give us a good idea because we're not seeing all of the 30s. They're all split up. So what I've created here is a macro. It's not called a macro in Stream Deck, it's called a multi-action. But what this will do is normalize this data into just a couple different fields that then we can look at a pivot table much easier. So if I add a column and then I click my button, so I'll just, actually if I click it over here, it's not gonna work. I'm gonna click it all in the Stream Deck, so you're not gonna see it, but when I click this button, it's going to start the multi-action. So let's make sure it works. Here we go. The action is starting to type out. And what this is just doing is creating an if the field in column E equals foreclosure, or if it equals foreclosure collateral sold, or if it equals FCL, any number of things that mean the same thing, it's populating this new cell with the senior status of foreclosure. Now look, it also is drawing down that column across the whole tape. So instead of having, oh, we started it down here, so that kind of screwed us up, but we can drag it up to the top. So what this essentially did, and we should have done is start it at the top cell, is take this cell over here, cell E, and then normalize it. If it's, and we only did a couple fields here. So delinquent are anything from 30, 60, 90, 120 plus days late in any of those different ways that we typed in, that we saw it typed in on this side. Current is either current or as agreed. Foreclosure initiated is FCL or foreclosure collateral sold or just the word foreclosure. Semi-current is 30 days late or rolling 30 or rolling 60 days late. And then unknown is everything else. So now when we run that same pivot table that we did before, we're going to see a much better representation of this data because it's been normalized, it's been cleaned up. So if we take the same thing, it's the same total, it's the same information, except we're seeing it all balanced across these different categories. And then the next thing I would do is just clean it up a little bit by putting it in the appropriate order. Current, semi-current, delinquent, foreclosure initiated, unknown. And now we have all of the different but similar fields all populated into one nice, neat pivot table. So very, very, very cool tool. It's basically putting this entire formula, and if we, oops, actually you can't really see it unless I delete this, but it's putting this entire formula into a macro that then is populated by the Stream Deck for us. So really, really cool tool that I've just discovered and messed with over the last week to put this together. Now I have another one for equity. Now equity is cool because it's another thing that can be normalized in a way that makes it really nice to look at on a pivot table. Whereas right now we don't have anything equity related. We have value and senior balance, which as you know, equity is fair market value minus the senior lien balance. Looks like there's some bad data here, but in any case, we're still going to run it. This is like an initial due diligence process before you pull credit, before you actually do all the legwork to make sure that this is verified information. So the way my equity button works, And that's, oh, well, let me actually show you how this multi-action works. So there's 85 actions in that senior lien status that we just did. And if you look at it, they're basically just hotkeys and text. So it starts out with just typing in equals if or. So it's an if statement with multiple inputs. And then we go left because we're tabbing over to the senior status column. And then we're adding the next thing. If it equals as agreed, and if it equals current, then populate current. If it equals back over to it, late 30 days, or back over to it, 30 days late, or 30, or rolling 30, these all populate delinquent 30, then it's semi-current. So essentially what this is doing is just typing in, and it was a manual process to create this, but once it's created, it just runs the same way every time so that you can just click a button and have this whole formula populate automatically for you. Now you could just copy this whole thing and then go to a text editor and replace E122, which is this field, with whatever field is in your spreadsheet. But what's cool with the Stream Deck is I'm able to do this without any other input. It's just a one button click. So let me show you the next formula I created here. This one, you add a column next to fair market value, senior balance, and current principal balance. And then you click that equity button, and here we go. Fair market value minus senior balance. That's the equity coverage. And then we're taking the equity coverage and telling us if it's above 1, it's full equity. And look, it's already done. That one was, oh, we did it too low again. Let's start over because that one was pretty quick. All right, so I'm deleting all that, going back to the top. All right, so watch it again while it happens so you can see what's actually happening. Equals fair market value minus senior balance divided by the current principal balance, and then taking that number and populating it into a normalized data set. So this one, equity coverage, is pretty simple. It's just the equity divided by the UPB, which I like to use because it tells you how much of a multiple above the principal balance is in positive equity. And then this one normalizes that so that we can see these numbers, which are like, you know, there's a bunch of numbers in here, and turn them into just a couple different fields. Full equity, partial equity, no equity, or underwater. Makes it really nice to use on pivot table. So we'll call that equity status. Now what we can do, because we've got equity and senior status, is run a really useful pivot table. So I'm going to take all that data, summarize with pivot table, new worksheet, and we'll take, let's go senior status, and we'll do equity on top of that. And then we'll look at the principal balance. All right, so I'm going to also order this like we did before, semi-current after current, then delinquent, and then look, let's do partial equity right under no equity, like this, right there. Okay, so we'll also make that into currency just so we can see it. And now what we see is full equity current senior. This is our creme de la creme second liens. These are the best quality second liens in the tape because they have positive equity behind performing senior liens. And then into slightly less quality buckets as we go down. And then the next big tranche, partial equity senior current, that's a really good category as well. Goes down, and then no equity, and then underwater. So this is a really, really cool way using the Stream Deck to automate some pretty simple formulas, well, somewhat simple formulas that normalize the data so that when we run a pivot table, we've got a nice and neat output instead of a bunch of duplicate entries that mean the same thing and don't really give us any actionable data. So I'm very, very excited about this tool, the Elgato Stream Deck, and hopefully, if we go over here, yes, you can see it. The Elgato Stream Deck, and I combine that for my streaming purposes with the ATEM HDMI switcher, and then over here, we've got our music and stuff. So that's the setup, that's the new desk setup, and hopefully we'll have some more to share with you next time around to further optimize our automation for due diligence and for streaming and for all of these different things that you can use with the Stream Deck. And now, the sky's the limit with this thing. Honestly, there's so much more that I haven't done. I really only spent about 2 days with it. Oops. And what that allowed me to do is just automate 2 of those Excel formulas that I use often. So as I put more of these Excel formulas together, they will be shared in the mastermind group. So if you're a mastermind member, you can get access to the formulas that I'm using that I have on the screen right here. So that you can use just copying and pasting these for your own purposes, or if you have a Stream Deck of your own, I can help you set it up. All right, so let's get on with the show here. That was what I was really excited to share with you, and I hope it makes sense. Please leave a comment if you have any questions. It's my first time like talking it through, so definitely maybe could use some questions to help refine that conversation, so you can get some more actionable insights from it, so you can do this yourself. All right, so let's move on to assets for sale, so I can show you just a couple of things we've got going on, just so you're ready for the next portfolio. So our next offering date is TBD right now, to be determined, but it's most likely going to be in the second quarter. And I do want to mention, for mastermind members, you have total access to the entire portfolio. Now, this is something that we just started doing in our February and March offering. Everyone who signs our non-disclosure agreement gets free access to, in this case, 70 loans for sale. But if you're a mastermind member, you get access to the entire portfolio that my client has available. Loans that they're still working out, loans that are performing, loans that are non-performing, so that you can see more product available for sale. And in this last offering, we had 170 plus assets for the mastermind members and only 70 loans for the rest of the market. So definitely join the mastermind group for that exclusive access. Also for the mastermind members is our aggregated trade desk. So in just 2021 alone, we've already aggregated $2.6 billion of unpaid principal balance from around the marketplace. And these are loans from other brokers, other sellers, different sources around the industry that you can, in between our offerings, and we only put out maybe 1, 2, 3 offerings a year, you've had access to all these other different sellers. And by the way, this is totally free. I'm not charging a percentage of deals that you close with our aggregated trade desk assets. These are just for the courtesy of mastermind members to have other opportunities to look at. And also, what's really cool for mastermind members is you can list your own assets on the trade desk if you're looking to sell a loan. And that's also totally free. I don't charge any percentage if you're putting your asset on the trade desk to sell. The only time I charge sales fees is if you want me to do the marketing and the negotiation and the contracts to help you get the sale done. But if you want to do it yourself, join the mastermind and you can do it in the aggregated trade desk. So that's assets for sale. Go to FIXnotes.com/buy in order to sign up for the non-disclosure agreement. All right, let's talk about case studies. An exciting, important part of the show is our review of some recent deals that we've been working on. So we haven't done one of these in a while, which is a foreclosure wipe. Now, this is a loan that was a total loss. So it's good to share these types of stories as well as the big wins, so you can understand some pitfalls and how to look out for some things that might bait you in the butt if you're not aware of. So this is a non-performing first lien secured by a single-family residential home that's worth $42,725. The taxes are unknown in this case, and the balance is $9,009. So we bought this loan for $1,700, which I think is about 20-25% of the balance. And we asked the borrower 3 questions when we have our initial consultation on a non-performing loan. What happened? Where are you now? And what do you want to do? And the answers to these 3 questions are what guide our resolution decisions, so that we're able to come up with a resolution for this borrower that's affordable, sustainable, and is a win-win at the end of the day. Because this business exists because we need to help borrowers. It doesn't exist just as a means of making money. It exists because we need to resolve troubled debt. And I think it's very good that there is a secondary market like this, because the banks have failed. All of the borrowers that get sold onto the secondary market have been failed by definition with the banks because they're not performing, they're not paying off their loans. So it's investors like our responsibility to get these loans performing again, to help borrowers pay off their loans that they've otherwise had difficulties with. So in this case, what happened? The husband of this wife that was the contact in this case passed away 6 years ago and left the co-borrower, the wife, buried in debt. She was unaware that they even owned the subject property. So this husband had made a bunch of dealings and took out a bunch of loans that the wife was not even aware of. So when we reached her, She's been working 48 hours per week to pay off these past due debts. It's been 6 years and she's still digging out from under this. The delinquent property taxes actually foreclosed on this property. So this wasn't something that we gathered in the initial due diligence. We didn't find this out until it was too late. It actually foreclosed 2 months before the loan was acquired. So the lien is no longer secured. And that means that there is no possibility for foreclosure. There's no possibility of enforcing this debt on the collateral because there is no collateral. So in this case, they were willing to pay off the deficiency balance. They were going to make payments towards it because they didn't have the funds immediately available. But this borrower wanted to make good on these debts and actually pay towards the deficiency balance. So you wonder, why is this a total loss? Well, it actually happened around November, the end of November, right before the holiday season. And we had a lot of really great deals concluding with the client who owns this loan. So I presented the situation to them along with this hardship letter showing, that the borrower was in real distress, and they were willing to forgive the debt. So that worked out really, really well for the borrower. We spent $125 on the expenses, the due diligence, the onboarding, and collections. Fortunately, though, it was only a month that we were able to cut the loss here, write off the loan, and forgive this borrower's debt, putting her in a much better position to resolve all these other debts that she was also digging herself out from under. So let's talk about some takeaways in this particular situation. First of all, the majority of borrowers want to make good on their debts. Even in this difficult position, our co-borrower wanted to start making monthly payments. So kind of surprising, but they were going, maybe it's not surprising. Most people do want to pay their debts. Nobody is taking out a loan unless they're a complete fraudulent type of individual. They don't take out a loan to then dodge the lender and never pay it. Everybody intends on paying their loans, but sometimes people get hit into tough situations. So in this case, we could have started a cash flow on that deficiency balance. Now there'd be no collateral securing that debt. If the borrower went to bankruptcy, the debt would have been wiped out anyway. The personal liability would have been stripped. But it was possible to start that small monthly payment cash flow. In this case, though, we didn't. We forgave the loan. Now, it's a funny little anecdote here. Another takeaway is to audit your servicer, because even though this loan was deboarded, and that means basically deactivated from the loan servicer back in November, when I was preparing this case study, I looked and saw that we were still getting hit with expenses on this loan by our servicer. So I reached out right away and they reversed the charges. But very important to audit your loan servicers to make sure when you deactivate a loan like this and provide the evidence that it is unsecured through the foreclosure of the unpaid property taxes, that the servicer does reflect that in your next monthly bill. So a little side anecdote takeaway there is to audit your loan servicer. And then finally, when you can afford it, do show some compassion. We talk about this a lot on this show, but with modification agreements, for example, when you get a monthly cash flow started, you need to make sure that that borrower can afford that monthly cash flow. And in this case, it was a pretty tight situation for this borrower, so we were able to show some compassion here. The client was authorized us to release the lien. Well, the lien was already gone from the foreclosure, but to satisfy the promissory note and to move on with another deal. This one we wrote off, and it wouldn't really have made sense to collect a small monthly payment on an unsecured debt because we'd be incurring servicing costs, and it really wouldn't have made sense. We can't resell an unsecured performing loan for any. This was also only a $9,000 balance, which is a lot of money for a borrower like this, and it makes a huge difference to them to forgive the loan, and it would have only made a very small difference to the bottom line of the company. So really great opportunity here to show some compassion since we were able to afford it, and then write this one off as a loss. So that's a loss situation, which kind of is an interesting twist because the borrower was willing to pay, but definitely something to understand. Property taxes and the inevitable foreclosure of delinquent property taxes is an important thing to understand. Now, there are some nuances in different areas, different counties, where with regards to tax certificates versus tax deeds, etc. So definitely look up in the assets that you're analyzing to purchase or the loans that you already own in your portfolio. Look up the property tax situation in that specific jurisdiction so you understand how their process works. And especially on first position loans, check your taxes before you buy those loans, because if the first lien is not being paid, if the mortgage on the property is not being paid, property taxes probably aren't either. It's one reason I really like seconds. If the first above the second is current, the property taxes are probably also current. But that was from last episode on first versus second, so definitely check that out. All right, so one more case study here. We're talking about another non-performing first lien secured by a single-family residential property. This one resolved through a loan sale. So we sold this asset for $23,000. It was a fair market value of $71,300. There's $8,500 in back taxes, which leaves us with an equity position of $62,785, securing an unpaid principal balance of $93,702. So right off the bat, you can see there's about $30,000 of negative equity in this position. And this is exactly what we alluded to in the beginning of the show with regards to pricing non-performing first liens. We're pricing based on the lower value here, the fair market value, not on the higher principal balance, because very, very unlikely that we're going to see anything above the value of the property in a collection effort on a deal like this. Now, this one we sold for $23,000, which was pretty well on the low end of the pricing guidance that we gave in the beginning of the show. Oops, wrong keyboard here. And a couple of considerations here to mention. First of all, this was part of a bulk sale. This was a year-end closeout of 2020 legacy inventory. A lot of our loan sales that we've done in case studies lately have been, but we just closed a whole bunch of deals in the last month, so maybe we'll start talking about some 2021 sales in upcoming episodes. So due diligence. This borrower was previously uncooperative. They didn't want to work out a deal. They just said, just foreclose and then we'll figure it out. And that's, they can do that if they want, but as a borrower, as you delay the situation and kind of force the lender to expend legal fees, you're just digging yourself more into a hole. And if a collection on this account was more aggressive, you could pursue the full balance, even if the value is lower. But typically we don't recommend that. We are in this business to help the borrowers, as we mentioned in the last slide. So in this case, we did have to initiate the foreclosure to show the borrower that this was a serious matter to address, and they continued to evade the loan mod. So we got pretty far along with the foreclosure, but never got the deal done with the borrower. So we sold the loan to a local investor who's more positioned to work out that REO, since in this case, a potential REO is really probably the likely scenario here. Unless the borrower at the 11th hour does pay off the loan, we probably are going to end up taking back the property. REO equals real estate owned. Now in this case, the final purchase decision was to pursue the loan, purchase the loan for $23,000 and continue with the foreclosure. That was what the investor who bought the loan intended on doing. So some other considerations here. In this case, the note buyer was better suited for REO management and this escalated foreclosure action. The client who owned this loan before it was sold really wasn't in a position to take back this REO, whereas the note buyer who bought the loan is more in the property management business, so they were in a much better position to take back the property if it came to that. Now, there's about $1,000 of foreclosure expenses already incurred by the client who sold this loan. So that gives the buyer an opportunity to step into the shoes of the previous lender, the client who owned this asset, and continue with the legal process. And then finally, that $8,515 of back taxes are going to have to be paid off by the lender to avoid the situation from the previous slide, which was the tax foreclosure. So that is included in the foreclosure payoff balance. Any expenses that the lender incurs in the collection process, including paying off the taxes, are then going to be owed by the borrower at the end of the day. In this case, because it's a negative equity situation, you might not ever see those funds, but technically you could pursue them as an investor. So $23,000 was only 24.5% of the balance and about 32.2% of the fair market value. And that's a pretty fair price for a loan with a sub $100,000 fair market value. And especially in a bulk sale, this is a reasonable price. Now, as a retail sale, this would probably be closer to like $40,000, maybe $35,000, about 50% of the fair market value. But with this year-end closeout of legacy inventory, this was the price that we settled on, and it was a win-win for the investor and for the client who sold the loan. All right, that's it for case studies for the day. And I think we just got one more thing here, and that's giveaways. So for giveaways, I'm offering 15-minute consultations to anybody who wants to chat about notes, real estate, YouTube, entrepreneurship. I really appreciate if you subscribe, like, and comment on this video before you book a call. But if you'd like, go to robbymax.youcanbook.me. You can get on my schedule for a 15-minute consultation, totally free. I'd be happy to have you there and see what you've got going on and how I can help. All right, so I can put myself back over here. Our upcoming schedule. So our mastermind call is the first Wednesday of the month, and that's coming up April 7th, 2021. And the final Wednesdays of the month is our Be the Bank YouTube show. So our next episode is going to be April 28th. Definitely check that out. And just to give you a final overview, a quick pitch, on the mastermind group. I'm like screwing up here. Our mastermind group is now at 58 members. We just got a new member last night. Very exciting. And this mastermind group is focused around our private Podio workspace. These are all the different apps that are included in the workspace. I also offer 50% off my consulting rates with mastermind clients, and we have monthly members only Zoom calls. Now, this mastermind group, and I've done some consulting on the other end where I'm being consulted on mastermind groups, and I pretty much, everybody I talked to said this was significantly underpriced, and this should be closer to like $10,000, $12,000 a year, $1,000 a month, not less than $100 a month. So we are moving in that direction. Eventually, this group will cost $10,000 a year to be a part of. And at that level, we're gonna have a lot more members and a lot more of that network effect. But by being an early adopter, by joining the 58 members that we have today, you can get in at a significantly reduced rate. Go to FIXnotes.com/MNM for more information. We've got 10 slots available at $80 per month. We just filled our last slot at 70, and we're moving up to 90 per month after these next 10 slots are filled, and then 100, then 110, and 120. Every 10 members, we increase the price by $10 until eventually it's going to be $990 per month. So definitely check it out and consider joining today. We also have I don't have any slide about this, but we have a really cool affiliate program where we're paying up to 100% of referred members' first month dues. So if you are a member and you share this with your network and you bring in some new members, you will be paid up to 100% of all of those new members' first month dues. So you can essentially make money by joining this group, and I would definitely encourage you to check out FIXnotes.com/MNM to learn more about it. And then once you're in the group, then you can go to our Podio workspace, which is podio.com/FIXnotes/mastermind, which has access to the trade desk, to calendar of events, to our forums and case studies, a whole bunch more there. So definitely check it out if you are interested. I would highly recommend you do so soon, because by the time you watch this video, the price may have already gone up. So definitely check it out. Okay, that's it. Thank you so much for joining us for another episode of Be the Bank. I'm always pleased to present what I'm learning in the business. And this episode, I was really excited to show you all that good stuff with the Stream Deck. I hope that maybe you'll consider maybe getting the smaller one. There's one that's only 6 buttons, and you could run, here's my Excel buttons, could run all of these Excel buttons on just a small little 6, I think it's called like the Stream Deck Mini or something. So definitely check that out. Thank you so much, as always, for joining. And maybe we'll just check out the birds one last time here. And let's see what we got. Oh yeah, we've got a little woodpecker out there to say goodbye to us. Oh, there he goes. Goodbye, woodpecker. All right, everyone. Thanks again. I'll be back at the end of the month. And if you're a mastermind member, I will see you next week, first Wednesday of April, for our members only call. And in the meantime, hit me up on Facebook or comment on this YouTube video. I'm happy to leave answers to any questions you have on YouTube comments. And there's many other ways you can reach me if you just look me up. So do so, and I'd be happy to help you find success in this business or in your real estate online marketing business. Whatever I can do to help, I'd be happy to. All right, without further ado, thank you so much for joining, and have a great day. I can't fade to black. I'm on my iMac camera. So, all right, ending the stream. Bye, guys.